Keeping the party going, talking about anchoring and adjustment with financial decisions here. And I want to give you an example. This was shown in the real estate market. And anchoring and adjustments, where we're anchoring to this arbitrary number and then failing to adjust our estimates either upward or downward to the appropriate price. This was shown during house appraisals. And so we had the same house appraised by two groups. So group one of appraisers had a house listed at $659,000, and group two had the same house with a listing price at $839,000. So a difference of $180,000. Same house, though, different listing price. And we went through, and both groups of appraisers came by, and this group came back with an average appraisal of $678,110, and the other had an average appraisal in group two of $751,190. Same house and appraised at more than $73,000 on average. So once again, these arbitrary numbers that are thrown out, people stick to that. So remember this, depending on if you're the buyer or the seller. If you're a seller, sometimes it makes sense to put a high listing price so people anchor on it, and then you can negotiate your way down. On the other hand, if you're on the buying side, don't fall for somebody's high listed price, because they might just be luring you with that high number to settle on a larger sale price. But that's the anchoring and adjustment in finance. Next, we're going to talk about the status quo bias. So remember, we stick to our status quo. We talked about free trials. This happens in our retirement account. Did you know that the median times an investor will change their portfolio allocation during their whole time of work is median changes? It's actually 0. So up to 50% of people will not change their retirement portfolio in their entire working careers. Now, what ends up happening here is two trends start to emerge. And this goes beyond status quo, but it is enhanced by it. We see a lot of investors coming out of college, and once again, they're not real sure what to do. And so we tend to see a lot of naive diversification, what we just talked about, where students who just graduated get out, start retirement contributions, and they start at 50% stocks and 50% bonds. And then what ends up happening, so if you're 22 years old, you have this 50-50 as a 22-year-old because you don't know any better, you're just getting started. And what you see over time is, let's say stocks are giving you 10% annually and bonds are going to give you 5% or 4%, 5% annually. And if you were to not change your portfolio over these next 40 years, so you're going to be the 50% of investors who won't change their portfolio, you don't touch it at all. That means if it were to grow over the next 40 years, when you are 62, you are going to have an 87% stock portfolio and a 13% bond portfolio, just based on how it grows over time. But when you're 62 years old, You don't want an 87% stock portfolio because now you're going to have what is called sequence of risk returns. We'll talk about that later. But anyway, what we can determine though here, and this is what happens, arguably 22-year-olds start out naive diversification when they should be more aggressive. So they're very conservative. They're too conservative. And then what ends up happening is people start realizing my stock portfolio is growing way faster than my bond portfolio over a long period of time. And they go, I like that. So put me more in stocks. So as they experience these returns, they become more aggressive. Now, what ends up happening is sometimes people get way too aggressive and they have what a portfolio should look like when they were 22 years old. So it should be reversed, but what we do see in reality is our status quo bias makes us too conservative at first, and then later on in life makes us too aggressive with our asset allocation. All right, I'm going to stop for there, and then we have 3 more biases to talk about, and then overconfidence. We are making our way through. I hope you're enjoying this, and see you on the next video.